Good afternoon. My name is Chris Gilmour, and I'm going to take you through what I see as being the outlook for the global economy and global markets and the local economy and markets over the next half hour, 40 minutes. Okay. Slide 2, won't get fooled again. I think basically to try and explain that title, there's an awful lot of strange things going on at this point in time, but I think one has to keep one's head while all around others are losing it. So, next slide, number 3. As far as the global economy is concerned, excuse me, the Trump presidency sticking to campaign promises, but finding it increasingly difficult to get legislation passed. And currently, we're sitting here waiting for possible tax reform proposals coming through, but it's proving a bit more difficult than was originally envisaged. US rate hiking cycle appears to be very much on track. We're looking for 2, maybe 3 more hikes this year. China slowing growth, fundamental shift, as we've said before, in economic dynamics, becoming much more of a consumer-based economy. Brazil and Russia, in deep recession, but their equity markets have been extremely buoyant, and we'll show you that in a moment. Russia probably back into investment grade status this year after only being in junk status for about 2 years. African growth intimately connected to Chinese growth, only looking at 1.5% growth last year and maybe a bit less than 3% this year. And much of that, of course, is predicated upon the oil price. If the oil price goes significantly higher, we could see a better outlook for sub-Saharan African growth than that. But as things currently stand, it's fairly feeble in comparison to what it's been in the past. IMF global growth outlook is pretty poor, only slightly better than last year. And I think some systemic danger is apparent to some countries in the wake of what happened in Brexit in the UK. Okay, number 4. As far as our market's concerned, the drought definitely ended in many parts of the country and having a positive impact on food prices. Western Cape still struggling a lot, and they've only got literally about 80 days left, maybe even less, and then they go into some severe problems with the water, under severe restrictions already, but things can get even worse in the Western Cape. Marginal economic growth improvement this year, but having said that, and we'll see this in a graph in a moment, we're looking for about 1% this year, FNB looking for 0.7%, and generally we're looking for a general downgrade of forecasts for growth this year. Did 0.3% last year, and we may just end up being roughly the same as last year. And certain observers are even for looking at the possibility of recession in the second half of this year. We think that's a little bit radical at this point, but it's a possibility. The twin deficits are still worrying. We've got a new finance minister in place, and we don't know as yet how he's going to tackle these deficits. Is he going to continue with the approach laid down by Pravin Gordhan and Kabisi Jonas, or excuse me, is he going to go his own sweet way? Politics very much intertwined with the economy and definitely going to define the direction of this economy. Ratings agencies downgrade. We've had a couple so far. We had S&P, which put us into junk on our foreign currency, sovereign debt, and we had Fitch, which put us into junk on both local and foreign currency. We're still waiting with bated breath to see what Moody's comes out with in the next few weeks. We think it's unlikely that they'll come out with a double downgrade as they did with Brazil a couple of years ago, which would put us firmly into junk status. But we could well be on the final rung of sub-investment grade with Moody's when they come out with their ratings. So we have to watch that carefully. Emerging from junk status could take many, many years. As we said a moment ago, Russia looks like it'll come out of it very quickly. Bear in mind, however, that Russia has got a big advantage over many countries. Its government debt to GDP is around about 10%. So, their ability to repay debt is very straightforward. We, on the other hand, are around about 50% debt to GDP, and it's becoming increasingly difficult to repay that debt. And if we get a downgrade on our local currency debt, and we see an automatic exodus of foreign bond funds because of that, to the tune of about $160 billion going out of our bond market, then that would undoubtedly result in higher interest rates here, and we'd see the rand taking a good beating. So the way things are currently structured, it could take some time before we get out of junk. Okay, next slide, number 5. This is the question of balance that I've shown many occasions before. The only thing that's really holding our markets up is the cheap money around from the low interest rates that are currently in the world and the quantitative easing that continues to be pumped in, notably in the European Union. But the Eurozone looks like they're going to start tapering, as it's called, taking off some of that QE in the next few months. And by the end of next year, it should be largely complete. So that part of the equation is not good for equity markets. And neither is the interest rate environment. As I said before, interest rates are rising in the States. And what's happening in the States today is probably going to happen in the rest of the developed world tomorrow. And I think it's very difficult to see how South Africa can manage to escape this upwards trend in interest rates either, even with inflation coming down. So I think that could be problematic for continuation of these very high levels of the market. And on the right-hand side there, we've got a whole host of negatives or potential negatives for the market, not the least of which is that we've got very high PE ratings. If you look at what Robert Shiller is talking about on a cyclically adjusted basis, the US market's never been higher. US corporate earnings are looking better. They're turning up, and I think we've got a graph on that a little bit later on. That's underpinning the market to a certain extent. If we see tax reforms coming through in the US, whereby, and I saw yesterday, there's a possibility you might see the corporate tax rate cut to 15% in the US. I think that would undoubtedly be good for the market. How on earth the US government would fund itself under those conditions remains to be seen. But nevertheless, I think the market would get a big boost from that. But generally speaking, there's an awful lot of negatives there, as that slide shows, and very few, if any, positives. So the market, and I'm talking here about the S&P, the Dow Jones, the US market, I think remains very, very vulnerable indeed. Okay, here's the outlook for real GDP in terms of growth over the next couple of years. World growth, and this is going to Barclays, we're looking at 3.7% this year, going up to 3.8% next year. Slow, gradual improvement. The developed world, 1.8 to 1.9, developing, and we've seen a bit of a pickup here. And I think that's one of the reasons why we're seeing this interest in emerging markets again, relative to what it was a year or two ago. They've upgraded their forecast from about 4.7 to about 5% this year, and from about 4.8 up to 5.2 next year. I think much of that is coming from China, and we'll see that in a moment. The US looking at 1.9% this year, 2.2% next year. Eurozone, 1.7% this year, 1.7% next year, pretty flat coming out of Europe. The UK, we're looking for a gradual reduction, 1.5% this year, 1.3% next year. UK is going to come under increasing strain, I believe, with their departure from the EU. They're going to have to forge new trade links all around the world, and that's no easy task in a world that is busy condensing, if you like. Japan are also looking like it's coming off a bit. Brazil, interesting, it looks like they're coming out of recession after being in a very, very deep recession for 2-3 years now. 0.5% growth this year, 2% next year. That is pretty good. Russia, we alluded to that earlier, 1.8% this year, maybe 1.5% next year. And against a background of an oil price that's not really doing very much, that's actually quite an achievement. Brazil, working very hard to try and get out of junk status, but I think it'll be a few years yet before they manage it. And it's interesting if you look at Brazil and do the comparisons, the inevitable comparisons with South Africa, it makes fascinating reading. So, yeah, they've got a very, very tough job in their hands. They've got high debt to GDP, around about 65%. So it's going to be tough for them as well. India, still looking fantastic. 7.6% this year, 8% growth next year. China, they've revised their forecasts upwards at Barclays, now looking for 6.7% this year, 6.3% next year. And South Africa, we're looking for only 1% this year, and 1.4% next year. As I said a few moments ago, there are certain observers out there, notably FNB, that are looking for significantly lower than that this year, 0.7%. So I think one must watch this very carefully. There are suggestions in the corporate sector that since the cabinet reshuffle and the first downgrade, business confidence has really fallen off a cliff. And when that happens, you tend to get a big reduction in investment, and business activity just falls back badly. So we've got to watch this very, very closely indeed, because if we start going to the sort of levels we had last year, or maybe even entering recession next year, that really does not augur well for employment or anything else in this country. And it means that our susceptibility, our vulnerability to further downgrades from the ratings agencies is heightened. Next slide, number 7. Okay, this is just the movement of the global equity markets over the past year. And you can see the line there in blue, which is the DAX, pretty much 20% up over the past year. Whereas the Chinese, the Shanghai Composite, I think, only around about 10%. But generally speaking, an upwards momentum over the past year. Next slide, number 8. Resources really only the main sector that is actually doing particularly well this year. And having said that, even resources are starting to come off. Fundamentally, things are not looking good there, because we're now looking at a situation where you've got the iron ore price, which spiked earlier this year, now around about $60 a ton again. And it looks like it's on a downwards trajectory. So, iron ore and copper and quite a few others still not looking very, very good. Next slide, number 9. Baltic Dry Index. This is just an indication of the value of commodities born around the world's deep oceans. And it's pretty much still at a 20-year low. Although we're looking at a very discernible upturn this year, the actual price of commodities as a group, and we must take iron ore out of the equation here because it's spiked and it's coming off again. But generally speaking, the price of commodities has not stood up particularly well. And that's reflected in the poor Baltic Dry Index. Next slide, number 10. Brent spot. And you can see here, we've been pretty much treading water for the past 6 months. And as I've said before many, many times, the reason for this is that a lot of the shale oil producers in the US, which hitherto, I'm talking about the producers up in the Bakken Formation up in North Dakota, they were really struggling to get their prices down, whereas the guys down in Texas had a much easier time of it. The guys in Texas and Eagle Ford and other formations like that can produce oil profitably at around about $30 a barrel. So at these levels, it pays them to get back into the market again. And the rig count in the US has been increasing for quite some time. So I think we're going to see a natural cap put on the oil price as a lot of these smaller but collectively very large oil producers in the US come back on stream. So despite the best efforts of OPEC and their surrogates, it looks like we could see a cap on the oil price, keeping it in that kind of 50 to 55, maybe going up to a peak of about $60 a barrel for the foreseeable future, but really not much more than that. Next slide, number 11. Just a graphic showing how big oil is in the overall equation. It's a $1.7 trillion industry. Iron ore is actually quite small in comparison. Gold's number 2, aluminium, I think, number 4 after iron ore, number 3. So oil is significantly larger than all other resources, all the commodities put together. So it's important that one gets one's view on commodities right, because that will tend to guide you in the direction of the rest of them. Next slide, number 12. Yeah, that's what I was talking about earlier, US corporate earnings growth. This slide goes back to 2011. And you can see it's been fairly volatile. But we've got a situation now where in the middle of 2016, it kind of bottomed out. And now we're looking at a year-on-year basis of earnings growth in the US as starting to improve and improve fairly noticeably. And if that carries on, then I think it's likely that we'll see confidence instilled in the US market, even although it's at extremely rarefied levels. And the limited amount of data we've had in the past few days and weeks out of the US suggests that we are getting better results coming out of America. So I think one can take a bit of comfort out of this graph. Next one, number 13. This is the all-share index, the price-earnings ratio over the past 20 years or so. And as you can see, although it peaked, it spiked there in 2016. It's come back to more reasonable levels of around about 19. Now, that's a high level. Historically, you can see that on only a few occasions has it actually been as high as this. Bear in mind, we have to come to terms with the fact that our market is now severely distorted because of two things. One, the removal at the end of last year of SAB Miller, which took a big and relatively high PE component out of the index. And secondly, what it did, it left Naspers as being the largest single component of our index on a properly weighted basis. So you've now got Naspers, which is about 20% of our market. It is extremely highly rated, around about 70, 80 times PE. So that distorts it. And if you're to take Naspers out of the equation, you would get what I'd call a normalized PE of around about 11 or 12, which is much more reasonable. In other words, what I'm saying is our market, excluding Naspers, is not especially high, but including it, it's very, very high indeed. So you pays your money, you takes your choice. You have to try and work out whether you should include that for a comparative purpose, and obviously you have to. But I think it's important to also note what happens if you take it out. So excluding it, not particularly expensive. Next slide, number 14. Okay, this is a series of three graphs. The blue line here is the S&P 500 going back to the year 2000, and the red line is US CPI. And as you can see, both indexes, by the way, are indexed to a common starting point of 100 back at the beginning of the time series. And you can see here that only in about the year 2013, in real terms, did the S&P come back into positive territory. And it's been there for quite a while, and it's spiked up nicely in the past few months. It's rising again rapidly. I'm getting concerned about this because when you've had a market that's done so little for so long, and all of a sudden it starts spiking like this, it tends to form what we call a blow-off because the economic fundamentals are really just not there. So again, watch this one very, very carefully for guidance as to what might happen to equity markets around the world. If this starts coming off from these very rarefied levels, and bear in mind, the outlook, as I say, for earnings is not that great. So the justification for these high levels is just not there. So if it comes off, then it could be quite rapid and quite profound. We could easily see a 10 to 15% correction in the US market if things conspire to make that happen. Okay, number 15. This is the same exercise, but with our market and our CPI. And the blue line is the JSE All Share Index in dollar terms. So what I've done is I've taken the currency out of the equation by translating it into dollars. But I think what this tells you is that from a foreigner's perspective, they love our market because it's very concentrated into a relatively small number of high-value, international, high-quality stocks, things like BAT, Richemont, Anheuser-Busch InBev. We've mentioned Naspers, obviously, and quite a few others. I think the top 10 account for about 70% of the total capitalization of the JSE. And from a foreigners' perspective, they like that because it means that they can buy all of these quality companies lumped into an index that will move quite nicely, when markets are with them. And by the way, this is a great way of protecting yourself if the rand falls. But even so, looking at it in dollar terms, it's actually been a fantastic performer over many, many years and has easily outperformed inflation. Next slide, number 16. Let's finish off with this series of graphs. This is the UK. Blue line is the FTSE 100, red line UK CPI. And as you can see, over the past 17 years or whatever, the UK market has been an absolutely dismal performer. In nominal terms, it's only marginally ahead of where it was 17 years ago. And in real terms, it's significantly lower. So unfortunately, the UK has not been a great place to put your money if you were just to go and buy a tracker fund in the UK over the past decade and a half or so. Next slide, number 17. This is the yield attraction of South Africa. This is why foreigners, investors and speculators alike love our bonds. I've highlighted South Africa there, 8.64% on the 10-year bond yield. And you can compare that with many other countries around the world. Australia, 2.6. Brazil, just over 10. Okay, we've mentioned Brazil. Brazil's in deep trouble. Looking at Germany, only just above in positive territory. China, 3.5%. India, 6.94%. So we're offering a very, very nice and a very juicy yield differential. And there are precious few countries in the world that offer that kind of differential. So I think that's really why foreigners like our market. Bear in mind, as I said before, if we get the downgrade, and I think undoubtedly, and I'm talking about on the local currency front here, undoubtedly we will see the bond yields spike up quite significantly, probably to around about 10% and maybe even higher. And that would, to an extent, manage to persuade hot money to keep coming into the country. But it would have to certainly rise from these current levels, even although these are attractive. And it also explains why the rand has been relatively strong over the past week or so, even with us being in junk status, because that yield differential is so attractive at this point in time. And provided we're in this period where we haven't as yet got the downgrade, the next downgrade, foreigners are happy to park their money here. But the moment we get downgraded, that could be problematic. Next slide, number 18. Okay. I mentioned earlier that even although Brazil has got an appalling economic situation and the outlook's not much better, money's been pouring into Latin America as far as the emerging markets are concerned. Excuse me. So last year, we saw emerging Latin America as a whole, in dollar terms, rising by over 30%. Emerging Middle East and Africa, rising by about 20%. The MSCI Emerging Market Index itself, around about 12%. If we're looking at MSCI World in total, that's the Morgan Stanley Capital International Index, around about 7%, and emerging market Asia around about 5 or 6%. So Latin America very much in favor last year. And if we drill down and look at which countries did best, we'll come on to that in a moment. If we're looking at equity performance year to date this year, Asia has overtaken Latin America. That's looking very, very good indeed. But they're both, in the first 3 months of this year, looking very strong indeed. And EMEA, which is emerging Middle Eastern, Europe and Africa, that's very much the laggard, only about 3% or less. Next slide, number 20. If we dig down and drill down into the best performing markets last year in dollar terms, Brazil undoubtedly the best performer with about 65% return. So you look at this and you ask, why on earth were investors and speculators alike investing in the Brazilian market when their economy was looking so deadly and the outlook wasn't that much better? And the same can be asked of Russia. These are two countries both in junk status, with Russia more likely to come out more quickly. But look at Russia's stock market in dollar terms last year, 55% up. So basically what this is saying is that if you've got a good enough story to tell, and if you've got the likelihood or the potential to come out of junk status in a relatively short space of time, then foreigners will buy your stocks because they'll buy for recovery. And that's certainly what's happened with Brazil and Russia. And countries like Peru, Hungary, Thailand, Colombia, incredibly strong growth in dollar terms last year. And I suppose we should mention here at the same time, South Africa up about 18% in dollar terms last year. So again, the foreigners are actually very, very well disposed towards emerging markets generally. And I think that explains why you've got this so-called risk-on situation currently, where they're moving away from the developed world, notably America, where they're getting a bit sick and tired of waiting for all of these reforms that Trump's talked about to materialize, and are happy to come into emerging markets like South Africa for the time being. And long may it continue. But the moment it turns, it could be quite vicious. Next slide, number 21. This is the same graph, but year to date. Interestingly enough, this is the year to date, the first 3 months of this year. Poland has put in a big spurt this year. So we're looking at about 17, 18% up for the first 3 months in dollar terms, followed by India, South Korea, Mexico, China, Taiwan, Turkey, Brazil, and South Africa's quite far down there, only about 4%. So obviously we're not as in favor as we were last year. And that may be a reflection of the heightened political uncertainty that's currently pervading the country. But as you can see, Brazil, although not as favorable as last year, is still very much up there with around about 10, 11% growth in dollar terms this year. Next slide, number 22. Retail sales growth in South Africa and the prime rate. Now, this is very illuminating. The blue line is prime rate, which is a proxy for interest rates generally. The red line is year-on-year percentage change in retail sales, and the purple line is a moving average going through that, 6-month moving average. Okay, now basically what this is telling us is that retail sales growth is declining. If you go back far enough in this time series, and you can even see it on this graph, there's actually quite a good visual inverse correlation between the two. So in other words, as interest rates rise, retail sales growth comes down. As interest rates fall, retail sales growth goes up. And at this point in time, interest rates have been rising. They've been steady for quite a few months now, best part of a year. But the chances are the next move is going to be up, and that could be in May. Now, you can see already that with retail sales growth, the trend is down. Consumers remain under relentless pressure, and if interest rates start rising again, maybe even only by another 25 basis points now in May, and maybe another 25 basis points by the end of the year, I think that would have an added dampening impact on retail sales. So I think what you can take away from this graph is that this is not necessarily the best time to be invested in the retail sector because the economic fundamentals are really not that good. Next slide, number 23. This is the rand. Okay, and a bit of explanation required here. The blue line going from top left to bottom right is South African CPI divided by US CPI, Consumer Price Index. And the reason for that is just an indication of relative inflation in both countries. Now, currencies, the value of a currency should have a direct bearing on the cost of living in each country. And therefore, that comes back to inflation. If inflation is relatively high in one country and relatively low in another country, as is the case between South Africa where it's high and America where it's low, you should see a gradual erosion of value of South Africa's currency relative to the dollar. And that's been the case for many, many decades. So the red line is the rand dollar exchange rate, the actual, but both of the series I've re-indexed back to a common starting point of 100 back in 1995, the year the financial rand was abolished, which makes comparisons probably more valid. And you can see on a few occasions, notably in 2004, 2005, and then again in 2010-11, we saw the rand approaching its theoretical value, its purchasing power parity level. But unfortunately, on both occasions, it deteriorated again. Now, you can see at this point in time, we're heavily undervalued relative to the theoretical, even although there's been a nice move upwards in the past year or so. But nevertheless, I think the likelihood is that given the situation that we have with the political uncertainty, given the fact that we are very much on the edge as far as further ratings downgrades are concerned, the likelihood is that improvement in the rand is not likely to continue. If anything, we're likely to see a bit of weakening coming through. And if we get a downgrade on our local currency rating, another one, I say Fitch has already given us one, but if we get one more, and then we get our bonds automatically being taken out of the World Bond Index, then that in turn would undoubtedly weaken the rand and increase interest rates. So we've got a very delicate situation here. The rand is undervalued, but I think likely to remain undervalued for quite a considerable period of time. Next slide, number 24. This is the Fragile Five. It's the South Africa, Brazil, Indonesia, India, and Turkey, plus Russia. I put the Russian ruble in here as well. Now, the graph might be a little bit confusing because an upward sloping graph actually means weakness. So you can see the Turkish lira over the past year has actually shown some profound weakness. You know, they had a military coup last year, and you've got an uncertain political situation, even although President Erdogan is cracking down on dissidents, and he's pretty much voted himself into power for the next 10 years or so. But nevertheless, the currency's taken a big strain. Now, if you look at the rand in red, it was one of the best performing currencies in the world last year and this year. But look what happened at the end of March with the cabinet reshuffle and the ensuing downgrade. You saw a huge weakness coming through relative to all the other emerging market currencies. It subsequently retraced a lot of that, but nevertheless, it still remains weaker than it was. So, again, I think just highlighting the susceptibility of the rand to political events. Next slide, number 25. And this is just the rand versus various currencies. And I think the top one there is the rand versus the pound. And as you can see, again, even against a relatively weak currency like the pound, you saw a huge drop in the value of the rand at the end of March there. And although it's retraced a bit of that, it's still pretty weak. And we're just showing it there against the yen, the Australian dollar, and the US dollar itself. Okay, next slide, number 26. This is the all-share year to date, or should I say from beginning of 2016 to date. And if I went back on a longer time scale, you'd see that the market's pretty much gone sideways for the past few years. And so although we've had a bit of strength since the beginning of the year, it's really not that fantastic. In dollar terms, we've done well, but in local currency terms, it's been a fairly pedestrian performer. Next slide, number 27. This is the very long-term case for equities. You can see going back to 1960, there's been lots and lots of shocks, both political and economic, to the system, and yet the market just keeps on going. So it's very, very resilient. Part of that resilience obviously related to the rand. When the rand depreciates significantly, it takes the strain because of the composition of our market, because so many international stocks are in that market, in our market. It has a very beneficial effect on the equity market itself. Okay, next slide, number 28. And this really just shows, again, the resilience of the equity market. The purple line is the all-share index. The blue line is the dividend in the index. The red line is the earnings in the index, and the black line is CPI. So over a long period of time, this goes back to 1980, the market has easily outperformed inflation and has been underpinned by earnings and dividend. Interestingly enough, dividend growth has overtaken earnings growth in the past few years. Next slide, number 29. This is earnings growth on the Financial Industrial Index, and that took a big knock in 2015, 2016. It's recovered a bit, but generally speaking, if you look at the fundamentals of our market, they're really not good. Earnings growth is currently running on a year-on-year basis at minus 10%. So I think that means our market could be vulnerable to shocks from wherever they come, whether it's from the S&P 500, which is hideously overpriced, or elsewhere. So our market, it's not that high, as I said before, particularly if you take Naspers out of the equation, but it's high enough to be affected by a shock to the system, given the fact that we don't have that good fundamental earnings underpin coming through. Next slide, number 30. Just really to conclude, the Trump presidency injects a lot more volatility into the whole equation. This promised big infrastructure spend be good for certain sectors, but we need to get much more clarity on this. Already, I hear this morning on the radio that the wall, the Great Wall on the southern border, may not now take place because we've now got an anticipated cost of $21 billion. That's a huge figure. And the question is, who on earth is going to pay for this? Certainly isn't going to be the Mexicans. So we need an awful lot more clarity on Trump's wishes, his wish list. The U.S. equity market is in its eighth year of upwards trend. It's tired. It needs a rest, and that's why I think it could be due for a correction in the not too distant future. Medium term things still looking much better in the U.S. There's an improvement coming through. The sentiment is looking much better in America. Consumer confidence is looking much better. And generally speaking, I think the chances are we could see this recovery in the U.S. carrying on for a few years yet. It is quite late into the cycle. And if we do get this big infrastructure spend that Trump is talking about, that could help propel it on for a few more years yet. And at an individual level, we're starting to see, we have been seeing for a while now, in fact, greatly improved personal balance sheets. U.S. interest rate hikes, they're pivotal in determining where the equity market goes. And we've had 2 rises in the past year or so, and the likelihood is we'll get another 2 rate hikes this year, and maybe even 3. It's indicative of the strength of the U.S. economy that Fed Chair Janet Yellen is prepared to even talk about having rate increases. So she's obviously confident that the economy can stand it, and that is going to set the direction for interest rates around the world, and it's going to be pivotal, as I said a moment ago, in determining what happens to equity markets. It also means that you now have, as an international investor, a choice. With interest rates going up, you've now got a choice. If you're nervous about the markets, you can park them. You can park your money in interest-bearing securities, whereas a year or so ago, you really couldn't. And the trend is going to be upwards. So I think in terms of bond markets, the 30-year love affair that investors and speculators have had in bond markets in the US particularly has come to an end. So the likelihood is we're going to see a continued rise in interest rates. We have to get back to a normal situation, in inverted commas, after many, many years of historically low interest rates. The Chinese growth stabilizing at or around these levels, even though we've seen a bit of an improvement in the past few months. Bear in mind there's a huge amount of debt in the Chinese economy, and that's going to put a cap to a certain extent on growth. The pound, I think, will remain weak on Brexit concerns. Prime Minister May has gone for an election on the 8th of June, and I think that's an incredibly opportunistic move. She sees the Labour Party in complete and utter disarray, and she's grabbing the chance with both hands. And good luck to her. I think she'll come back with a very, very large majority. And I think she'll need it because had she waited until 2020, when the Parliament would normally have dissolved, then I think the British economy could be in far worse state than it is today in the wake of Brexit. So we have to watch Britain very, very carefully. Europe improving only very slowly and very, very grudgingly. Thankfully for Europe, we're probably not going to see a Marine Le Pen presidency, and the markets took that very positively the other day. So that's one piece of good news, I think, for the Europeans. Next slide, number 31. As far as our markets are concerned, the total return last year was flat to slightly up, about 2% last year. Really wasn't very good. As we said before, the US dollar return much higher. The rand remains fundamentally weak. We could see a few intermittent bouts of strength, as we saw in the past couple of weeks. But generally speaking, I think the trend's going to be down. There's heightened political risk. We are in the last few months of the Zuma presidency. We're just not sure what he's going to do. And the likelihood is we're going to see his ex-wife, Nkosazana Dlamini Zuma, being installed as the new president of the ANC. And going with that, if the ANC manages to pull off a victory with more than 50% in the elections in 2019, she'd become the president. So again, that's interesting prospect there. Higher interest rates. The Reserve Bank doesn't necessarily want to have higher interest rates, particularly with inflation coming much, much lower. We should get back into the target range that the MPC has dictated of 3 to 6% later this year sometime. And with that in mind, it would go against the trend if we started putting rates up. But I think the Reserve Bank will remain under intense pressure to keep rates up, even although inflation is coming down. Retail stocks, as we said, I think will be vulnerable. They've come off a lot in the past year or so, but nevertheless, they've been exhibiting great resilience. I think that resilience will be tested to the maximum this year. we're not positive on retail stocks at all. A few green shoots in the smaller construction stocks. Property stocks still looking very good, nice yields there, and offshore property looking especially attractive. On government bonds, I think one must be very, very careful because even though we've got yield seekers coming through from overseas and buying our bonds, and they've come back in force, if we get a downgrade, a further downgrade, and particularly on our local currency debt, then those bond yields are going to spike upwards quite significantly and quite quickly, which means that if you want to trade these things, then the prices of the bonds will come down. And our view on rand hedges would be at these levels, at this relatively strong level of the rand, we are still telling our clients that this is a good time to be buying things like our global equity portfolio, for example, or rand hedges generally, things like the DBX trackers. Because of the likelihood that the rand is going to depreciate with the relatively strong rand we've got now is a good time to be buying. And then last slide, which is just the disclaimer. That's me finished the presentation, and we can now go for any questions. All right, there we got a couple of questions coming up. The one graph which showed the relative performance of various countries around the world in 2016 versus South Africa. Be interesting to split the return between the appreciation, depreciation of the currency and the actual performance of the equity markets in local terms. Very good point. And one can do that. I mean, where I glean my information from Reuters, for example, they do precisely that. They show exactly how the markets have performed, both in local currency and in dollar terms. And the question goes on, for instance, I see that overall return for the SA market in US terms was around 17 to 18%, quite right. Of this, only 4% was actual growth in the equity index, whereas the major part, 13%, was in the strengthening of the rand. Absolutely correct, quite spot on. In essence, a foreigner was probably taking more of a view on the rand as opposed to the market itself. Absolutely right. No, you're quite right. And it's interesting to contrast and compare the view of foreigners with local investors. Foreign investors are seasoned campaigners. They have to deal with all sorts of political and economic conditions all around the world. And while we sit here in South Africa saying, wow, it's terrible, the end of the world is nigh, the foreigners think, well, you know what? There's an awful lot worse than South Africa out there, believe it or not. And as a result, they take a view. And if enough people take the same view, it becomes self-fulfilling. And I think that's what we saw last year. So, and a similar situation with both Brazil and Russia. And your remark there about South Africa and pulling out the rand component from the performance applies equally, in fact, even more so with Brazil and Russia. So the real was an outstanding performer last year. And if you pull that out, yes, there was a better improvement than what we had locally, but even so, the improvement in the currency was the big deal last year in Russia and in Brazil, as well as in South Africa. Okay, well, I think as there are no more questions, we'll leave it at that. And I'll just sign off by saying thank you very much. And I've enjoyed giving this series of presentations. And thanks and goodbye.